out, but what's really potentially the real thing to look out for is delinquencies. When people stop paying, it's it just like with the issue we had not long with Silicon Valley Bank and with First Republic, their assets were fine and they were being serviced. It's when you start getting defaults, delinquencies, impairments, and that's when things start getting really bad.
We'll be speaking today with Michael Sheren. He is a president at MetaVerse Green Exchange, MVGX, and he was the senior advisor to the Bank of England and also the co-chairman of the G20 Sustainable Finance Group. His background allows us to speak about a multitude of subjects, which we will cover today, including the debt ceiling, monetary policy, green finance. Michael, welcome to the show.
David, it's a real pleasure to be here with you and look forward to a really kind of a nice trot through a whole variety of subjects today.
Michael, let's start with current news. So the debt ceiling is getting close to being passed. Lawmakers have to vote on it this week. Interestingly, it caps non-defense spending. I'll just read a paragraph from the CNN article that came in last night. Under the deal, non-defense spending will remain relatively flat in fiscal 2024 and increase by 1% in fiscal 2025. According to a White House official, after fiscal 2025, there will be no budget caps. What is your view on how this may change spending from Congress?
Well, looking at the budget, it doesn't look like there's going to be any significant changes in spending, to be quite honest. There are going to be some reductions, but at the end of the day, if you look at the trajectory of spending, it's really only marginally below what it was on the course it was on prior to the bill. I think the most important thing on this was just simply getting it passed, because obviously a default, as much as the debt is a systemic issue that needs to be addressed by Congress, at the point of just literally we had a gun at your head and saying we need to do it one way or another, they had to get this passed. And if you notice, it is good until after the election. So from a political point of view, they've kicked it into the next administration, whoever that might be. But at the end of the day, there were not meaningful cuts. And again, it's a typical balance between social programs, military, paying the debt. But as I said, for the time being, they needed to pass this budget. They couldn't afford to dance on the head of a needle any longer around whether the government was going to default or not. But I think the real serious talk, the real serious restructuring is going to take place after the next election.
You're right. They've made some cuts to the IRS. They've made some clawbacks to the COVID-19 relief funds. The fear that Janet Yellen was broadcasting about a month ago about the U.S. Treasury running out of cash by June 1st. Well, it's June 1st today. Is that fear still relevant after recent news and developments in this debt ceiling deal? And can we expect everything to be okay with public workers getting paid?
Yeah, it looks like Yellen's been able to push that if she needed to the 5th or 6th of June. And if all goes as anticipated, the Senate will address it tonight, and that should pretty much put things over the hill. So the way it looks at this point, that they will not have a hard stop, that federal employees should be able to go to work and things will carry on as usual. One other thing that you brought out, which was a really important point on the things that were cut, and that was there was some serious additional funding that was given to the IRS, which would have been potentially a way of bringing in additional revenues, but that was cut. And I think that was as much a political aspect as it was a fiscal.
What do you think the administration's objective is right now? It's 1 year before the election, so pre-election year. What are they trying to do in the next 14 months or so?
Keep the boat steady. Basically, they're hoping there's no recession. And what it will be interesting is I don't think there'll be a hike in June, but there may be one afterwards. And again, every single hike of interest rates is more pressure on mortgages, more pressure on corporate debt, more problems on credit cards. But what they're trying to do is both tame inflation and not drive the economy into a recession, which is basically trying to thread a needle at this point.
Okay, so the larger issue, Michael, is that the U.S. deficit and the debt relative to GDP have both been climbing over the last couple of years, past decades really, at a steady pace. Is this pace of growth of debt and the deficit widening, are these sustainable?
Yeah, that is the question that's been out there, as you pointed out, for close to 20 years, actually even more than that. I remember during the Clinton administration, I started on Wall Street in the mid 80s, so it gives you an idea of the times I've been around. But at the end of the Clinton administration, if you recall, they retired the 30-year Treasury bill because basically the annual budget had come into balance. So there is a potential of getting there under certain circumstances. But like all governments, they didn't take advantage of when the time is good is when you start paying down and when you start actually cutting into the accruing national deficit. To answer your question, yeah, at some point they have to start chipping away at that. And it is always the fine balance. Where do you cut? I mean, you have to pay your interest. There are certain key things around Social Security. And I think you need, well, I don't think you certainly need positive growth, GDP growth to generate tax revenues to be able to find ways of actually starting to retire some of that. And I don't think we start seeing any meaningful reduction in that until the US economy gets to the point where it's on a steady foot, there's growth, and that they can start actually using some of that excess revenues to start chipping down at it. I think it's going to be tougher now because as T-bills roll over, 2 years ago, they would have rolled over at a real, almost negative interest rate. Now they're going to be rolling over at meaningfully higher interest rates. So that's going to make retiring or chipping away at that, at least in the midterm, a lot tougher.
So currently, total public debt stands at above $30 trillion. Now, Michael, over your career, have you observed a relationship or correlation between the level of debt and long-run growth of the country?
What you're really talking about is, are you pulling liquidity out of the market? Because ultimately, if banks don't have the money and it's being sucked up by the treasury bills being issued, you're pulling liquidity out and you're having basically a reduction in growth. Interesting right now, I think there's a variety of things that reduce liquidity. And one of those, particularly in unstable times, is high interest rates. If you look at what the banks are offering, and I know we'll touch a little bit on what happened with the mid-tier banks as well, but ultimately, if you're a depositor, do you want to have your money now in a mid-tier bank, or to be fair, even in some of the bigger banks, when you can go into a money market or you can buy 3-month, 6-month, 12-month treasuries at much higher rates? So that is basically that money that's coming out of deposits, that's coming out of both mid-tier and some of the big banks, going into treasuries, is also reducing liquidity. So again, you can see there's a multitude of both fiscal and monetary things at play, and none of them are going to be terribly helpful for generating that type of growth and basically putting a crimp on liquidity. So to answer your exact question, additional debt reduces liquidity, high interest rates reduces liquidity, and reduced liquidity means less growth.
It doesn't impact consumer and or investor sentiment at all? Is that something we can tangibly feel in the real economy?
The American consumer is quite amazing. It's almost impossible to kill them. They have they have been spending. Now, obviously, there was a lot of pent up cash post COVID. People that had jobs had basically weren't spending both on general consumption, especially services, as well as hard consumption. And then you had the bills that supported people as well, which allowed them to build it up. And so when we started coming out of COVID, people started spending. They had been sitting in their homes. They wanted to buy things. They wanted to travel. And as you know, and I'm going to round it here, but I believe of the U.S. economy, you're talking close to 70-75% is consumption. It's driven by those consumers. It's not, America produces a lot of goods. It has a lot of production, but it's really the consumer. And so far, they have been, particularly on the service side, there's been some data recently that's been showing they're pulling back a little bit on tangible goods. But the service side, they still want to travel, they still want to go places, and they're still playing. So I don't know at what point these rates actually start biting them, when they have to start paying more for food, for their mortgages, for their car loans. And at some point, it's got to bite, but it really is only bitten in a few areas so far.
Yes, let's talk about the household and consumer first before we tie that into monetary policy. I'm looking at the St. Louis Fed data. Household debt service payments as a percentage of disposable personal income. It's currently sitting at about 9.7%. This ratio has been climbing ever since the beginning of the pandemic, like you mentioned. However, it's still below pre-pandemic levels. People have to zoom out and look at the chart over a multi-year basis. And so, generally speaking, people are concerned about household debt. But I'm looking at this chart. It doesn't look like it's that much of a concern if you compare it to historical precedents. People have been levered up more in the past, and the economy was fine.
Yeah, no. They seem to be spending, and they still using they're using their credit cards, and they are levering still. The real question is when servicing that starts to really cut into your household income. Is I think that's when, if we're going to see a recession, I suspect that starts biting around Q3, and it's probably not going to be a deep one. But I think at that point you can't keep spending as the rates. I suspect between now and Q3 we get at least one more hike, and the real question is how much more can they take?
The cab driver was having a conversation with me yesterday as I was taking a cab.
I'm probably a far better expert on these things than I am. The London cabbies know more. That they've forgotten more than I know sometimes.
It's remarkable. He was saying, I don't expect I don't expect rates to go down this year either. He was giving me this analysis, and I was thinking, well, what do you do for a living besides this? But anyway, we were having a conversation, and his car loan payments went up. His car was he financed at 1 point something%, I don't remember, but now it's at 7.
Yeah.
I mean, and my question that I didn't ask him, but my question is are you affording this right now? I mean, is the economy booming by 7 times such that you can offset your debt servicing payments on your car? So let's talk about that. The big question on every
how much did he charge you for that ride?
It's the same. Yeah, I don't. Yeah, exactly. He didn't charge me extra. I mean, it was the same as. Look, inflation hasn't hit the cabbies here in Canada. Let's put it that way. But I'm curious, Michael, and everybody watching this would be curious as to when interest rates would fall down. Let's start with the U.S. and North America.
Okay, look, I'm pulling out my crystal ball, and it's difficult to tell, but you can see the inflation, and the whole reason for the rates up, obviously, are just to kill inflation. The only way you can kill that is you kill economic activity. I suspect Q1, Q2, they would love to bring it down, but it's remained sticky, particularly in areas like food. And so I'm guessing probably the first half of next year. They will try and hold them as much as possible. That's why I think we've probably got at most one more raise in the fall. Their preference, my guess, is to hold it after that raise, but it's and again, I'm going to mimic or parrot Jay Powell. It's data. It's going to be data specific. If the data doesn't show it, if inflation remains sticky, if cost of food, cost of energy, the core inflationary things still remain high, you may see another one in the late fall going into the end of the year. But if you're asking, which you did, when it might start coming down, if we start seeing inflation coming down, and by the way, when it does start coming down, I think you're going to see the Fed not go down in terms of quarter points or half points. I think they're going to be slashing rates once they're sure that inflation is dead, and that could be towards the back end of next year. But once they're sure that all the drivers of inflation are really put to rest, they're not going to go down 25 or 50 points at a time like they did going up. I think they'll still slash 50, 75, 100 points at a time. But we're not there yet.
Why would they do that? Is that to prevent a further decline in the economic growth, like a big recession?
Exactly. I mean, look at the last time rates were anywhere near this way was back again when I when I was a college student, and that was ultimately when Paul Volcker was the Fed chairman, and he had to bring up rates. I actually remember mortgage rates being at 19% if you could get one. It was extraordinary, late 70s, early 80s. Fortunately, we don't have that level of inflation. And if you think about it, the Americans have both supply side and demand side inflation. I think the higher rates will knock down some of that demand side, which obviously is around the consumer. On the supply side, as long as you start getting energy, food, the things that are imported in. Now, the U.S. is pretty self-sufficient on a lot of things. They are still reliant on some products. They like that, whether they're BMWs and Mercedes coming in from Europe, or whether that's certain types of crops coming in, soy that are coming in from other parts of the world. But once that starts coming down the supply side, inflation side, and again, we've got a variety of things that are doing that. Obviously, grain. Russia, I think, is the second or third largest producer of wheat in the world. Ukraine, I think, is number 5. Until that's sorted out, you've got commodity issues in the grain. That's inflationary, highly inflationary. So there's a few things that are on the supply side of inflation that are outside of the North American control. So I think the interest rates will knock down a lot of the demand side as we get into the end of this year, early next year. And if you can get some level of stability in energy prices and core food on the supply side globally, then you'll start seeing some real movement down. But those are your demand and supply and demand side pieces of the inflation puzzle, and there is not a clear view yet that we've gotten all the issues related to that put to rest. You still have some big outstanding problems.
On the topic of interest rate hikes or a pause, so currently I'm looking at the CME FedWatch tool, and which tracks the target rate probabilities for the next meeting, and it stands at 74%, 73.8% of no hike. So more or less in line with what you're estimating. It's interesting because a few days ago, about a week ago, when the PCE data came out in the U.S. hotter than expected at 4.7%, that probability was reversed. So there was a 66 or 67% probability of a 25 basis point hike by the next meeting. And now, of course, that's reversed over that last week. So it's understandable because inflation was hotter than expected when it came out. And over the course of the last 7 days, I guess people either forgot about inflation data or they're preoccupied with other things. But that no longer is a concern.
Yeah.
So
and it's interesting. Yes. The job prints have been hot too, been going up and down. So just when you think it's your employment numbers are kind of coming down a bit, then you get another hot print. And I do have a certain amount of sympathy or empathy because it literally is data contingent whether you're going to hike or not. And literally month to month, you're getting a combination of hot numbers and then cold prints.
Michael, you've had experience advising central banks, particularly the Bank of England. In your experience, what are the common policy errors that central banks make?
Well, what's interesting is a lot of people call them errors, and in reality, it's about timing. I mean, everyone kind of is roughly on the same page on what the problems are and what the solutions are. Really, what it comes down to is timing. If you recall, when inflation first set in, Jay Powell used the phrase, it was transitory. Well, some of it actually is transitory. But what's your timeline on transitory? Is it 12-month transitory or 36-month transitory? So to your point, in retrospect, a lot of central banks probably should have started hiking earlier. They thought that some of that transitory inflation was going to be shorter tenured, and that it was going to burn off quicker, which it didn't. So I think really, and by the way, in the market, if you're early or if you're late, even though you're right, you're wrong, because ultimately it's about the timing. And I think in terms of the central banks, it's the same thing. They know they've got the basic tools. They know what they're going to do. It's being able to pull the trigger on when do you want to start bringing the rates up and how hard do you want to push them. And if you look at some of the economies, no central bank wants to raise rates until they're absolutely sure. But as, of course, Larry Summers pointed out, and I do tend to agree with him, both the Fed and the Bank of England and even the ECB were a little behind the curve and started hiking a little late.
If they're behind the curve now, are they going to play catch up? Which leads to my next question. The Federal Reserve, you think, is going to pause, at least in the next meeting, maybe the rest of the year. What about the other central banks, the ECB, the Bank of England, that has to still fight inflation? What is their policy objective going forward into the 2024 arena?
Yeah, they're all very different. Normally, a lot of the central banks are very similar and aligned. The UK has its own special set of problems around Brexit. So Brexit made the pound much cheaper, lower. So that means anything they import in the UK is highly dependent upon imports, everything from food to basic commodities. That puts a natural bit of inflation in right off the bat. So before the standard inflation, you've got currency inflation that's on top of it. So even if foods are elevated in terms of your price, the pound you're buying it with is actually a weaker pound. So that makes that inflation even greater when you bring it in. So the UK has got a particularly a tougher road to hoe. So I suspect there will be at least one more hike, maybe more. It's going to be tough, and some of it they will not get rid of because some of that loss of the movement, that easy, quick movement of commodities and basic, as well as labor, by the way, between the EU and the UK, will continue to provide inflationary issues in the UK even after the global supply side elements. So it's homegrown, home created inflation on top of. So that's a unique one. So they're kind of in a tough spot. So consequently, and I was just reading. There's about, I think in the next 12 months, 2 million homes are going to come up for mortgage renegotiations. And it is going, and it's been over a decade. People have been used to paying 1.5%. And unlike the US, and I'm not positive how mortgages work in Canada, but in the UK, most of them are floating rate. You can fix for 2 years, but it's pricey. I think the most you can easily fix for is 5 years. So you don't have a 30-year mortgages like you have in the US. So a lot of people are going to be, when they come off their current mortgage, even if they were fixing them every 2 years, when they come off and have to redo it, it's going to be punishing. So that's the UK. So they're not through hiking yet. The latest print on inflation in the EU has been pretty good. I think there's still some room for them to continue to move upwards, but they don't have some of that homegrown inflation, and they don't have the as much of the demand side inflation as the Americans do. So I think you're going to see a little bit more movement up there, but I think ultimately they're going to be in a position as long as, and you saw Germany just went into a mild recession. The UK keeps skidding around it, but they're effectively at no growth and high rates. So they've got basically stagflation.
Interesting. Bottom line is, do you think there's going to be significant interest rate differentials that would weigh either down or up on the dollar?
Yeah, I think the dollar right now, as you've been seeing, has been under some pressure. I think if the prints remain hot, the dollar will hold. Once you start seeing the crack in the inflation in the U.S., I think you'll see, as I said, an accelerated movement downwards in the rate, which will basically take the dollar and basically reduce the value across Europe and the other high rate environments like the EU and the UK. So it is something. It's been under pressure now. It'll be under more pressure, I suspect, towards early half of next year. Hopefully that's when they crack the inflation nut and they start reducing rates.
All right, well, let's go back to the banks. So JP Morgan acquired First Republic a few weeks ago. Since then, it's been somewhat quiet on the Western Front when it comes to headlines regarding the regional banks. So are we out of the woods now? Is the story over?
Well, we're partially out of the woods only because basically all deposits are now guaranteed, which helps. But that doesn't help on the behavioral or the contagion effects. I think for the time being, it has gone out of mind. But as I said, you've seen a lot of deposits exiting both the regional banks, but I would argue even some of the larger banks are seeing some of those going into higher rate providing places such as T-bills and money markets. So again, that's, as I mentioned before, that's a bit of a liquidity issue. But moving back to the regional banks, it's extraordinary that a lot of people were thinking, well, Silicon Valley Bank, First Republic, that ultimately maybe it was because of their business model, especially Silicon Valley Bank, because they're so tech focused. But at the end of the day, most of the failures really came around just banking 101. Treasuries within those banks didn't hedge. So in terms of their assets, they had a lot of treasuries, they had a lot of mortgage-backed and other asset-backed securities, and they remained unhedged. So consequently, if you're a year and a half, if you were 18 months going backwards, 18 months ago, and you're thinking, all right, I've got a big portfolio of US treasuries and and asset-backed securities, interest rates are effectively at zero, or actually in a real basis, in some cases below that. What direction are rates going to go, I wonder? Only one direction. Only one direction. Now, mind you, if it doesn't look like they're going to go up, your hedge is cheap. It's an out of the money hedge. Great. But the thing is, the central banks had been signaling that ultimately, as we were coming out of COVID, that and inflation started kicking in. You had the war in Russia. The one thing that you would want to do is hedge. They didn't. And that was arguably left them highly, highly exposed because, as you know, rates go up, the value of bonds go down. And so you had basically unrecognized losses at that point. They weren't crystallized. But if you were to look at their bond portfolio, and by the way, they're high quality bonds, most of them were US treasuries, and a lot of them were asset-backed securities. But the problem is, if you're unhedged, as rates go up, the value of all your really high quality debt goes down. And so anyway, that was extraordinary. That it's banking. If you were a 21-year-old college student going into your first year as an MBA, and I gave you that scenario, what would you do with rates at zero, signaling from your central bank which way they're going? You'd probably hedge it, or even buy tips, buy something that's inflation linked. But at the end of the day, it's really left the banks in a really tough spot. Those mid-tier banks.
I'm just curious. This is sidetracking for just 2 minutes here. You've been a banker for a big chunk of your career as well. If this had happened during your banking career, this regional banking crisis, what is your thought process here? Would you be concerned? Are you looking for another job? Or is this just shopping season for acquisitions? It looks like shopping season to me.
Shopping season. If I'm Jamie Dimon, it's shopping season. I mean, as you know, First Republic is again it's a unique bank. They do lending to high net worth individuals. They do jumbo mortgages. From what I understand, the underlying portfolio of loans were pretty good. The problem is when you're hemorrhaging deposits, it just doesn't it doesn't help, and it gave J.P. Morgan a great opportunity to swoop in to a really good little regional lender. So consequently, they benefited. But the point is, if all of your deposits start concentrating in your big 4, 5, or 6, if you think about most of the mortgages, if you're traditionally, when you start going out into the Midwest, California, a lot of these small mid-tier banks are the ones that provide the mortgages. What happens there, or the consumer loans or the car loans. And that's why Fannie Mae is so big. I mean, basically, a lot of those mid-tiers sell to them, and they do your mortgage-backed securities.
So when rates go up, bonds go down. You know what else goes down when rates go up? Value of real estate. So this is a tweet from Elon Musk. Commercial real estate is melting down fast. Home values next. Do you agree?
Well, UK just went down. Home values went down, I think, the most in 17 years, around about 4%.
Wow.
Yeah. So it's the first time we had a real big boom in valuations of homes coming out of COVID, but it's now starting to bite. And exactly to your point, look at it costs a lot more to service a house. And again, as I mentioned in the UK, you've got floating rate, and you can only fix for 2 years. 5 years, it gets expensive. At that point, the price of the house has to go down. There's no place to go. And I think what's interesting is with the commercial real estate, and I don't need to tell you, San Francisco, other really big money center areas, you've got huge amounts of vacancy rates, but you still have to service the debt. And so it's a combination of things. One is so many people are now still working from home, even if it's only 2 or 3 days a week, you're in the office, that's 20% less office space you need if you can organize that. So I think it's a double whammy hit on the office sector. Really tough. But I do think, to answer your question, and I think Musk is right on this, it will, if we do not start seeing some relief in the rates, if inflation remains tough going beyond second quarter next year, which I'm hoping, at least in the US, it might start breaking. If it doesn't, only one place for valuations of homes to go, and that's down.
Well, that's the concern here is that because the commercial banks, the regional banks, hold a significant amount of commercial real estate on their books, that they're going to see significant write downs over the next year or two. Um, I don't know if this is going to add to the crisis of regional banks.
Yeah, the big question, there is a potential for write down, but what's really potentially the real thing to look out for is delinquencies. When people stop paying, it's it just like with the issue we had not long with the with Silicon Valley Bank and with First Republic, their assets were fine and they were being serviced. It's when you start getting defaults, delinquencies, impairments, and that's when things start getting really bad. So I agree. I think the mid tier banks have got potentially storm clouds on the horizon, and if those start manifesting in delinquencies, then we've got some real problems.
Now, I want to learn a little bit about your company, the MetaVerse Green Exchange. So I know about the metaverse. I know about a little bit about green finance, which I would like to learn a little bit more about from you today. I have never heard the terms metaverse and green in the same sentence, let alone in the same company title. I'm curious as to what your company does and why it's called what it is.
Yeah, well, to be honest, we find a lot of people are confused, and there may be some opportunity to rethink that. But there was a very, very firm plan in terms of why it was named that way, but it doesn't seem to resonate as much as we'd hoped. So what it really comes down to is we're a tech-based company. The founder has got his PhD in physics from MIT. We've got 70 coders. Our chief technology officer is amazing. She did her engineering degree out of Stanford. So we've got a group of really top engineers and tech folks. The thing is, they have a really big commitment to basically doing sustainable finance and sustainable software. So a good way to think about us is we have three areas of business we do. One is software solutions. So we we do the coding and the work for partners like Oracle and Tusud. So if you've got an ESG suite that is provided by Oracle, we actually have a relationship. And in Asia, we actually write some of their stuff. So we've got actually a software piece that does that. We also have developed carbon registries for governments, and we're currently in negotiations and bidding for four national carbon registry opportunities. So from the software side, it's quite extraordinary. Now, on the way to look at, I guess, from the why metaverse is if you can digitize everything. Imagine a standard bank. I'm providing you a loan, home mortgage. So normally you would either come into your bank, you would visit your banker, but what we're looking to do is start digitizing everything, having digital representations, which will bring down the cost of financing. So consequently, you can either approach a loan either through a web portal or ultimately in person, mostly through a web portal. You would normally sign a security agreement and a mortgage, or a security agreement and a loan documentation. That can be both. We're looking to digitize that and also run them off of smart contracts. So it's an if and then. So ultimately, once you've provided all the information, the due diligence, which, oh, by the way, the due diligence is all digitized. If we were financing, and by the way, the home we're financing for you is a green home. And what defines a green home is energy and water efficiency. And there's real matrix on that. So it's not a if or what. So in the US, there's a 1 to 100 scale on terms of energy efficiency. We're not in that market. But for most buildings, there are very empirical ways of measuring both your energy efficiency and your water efficiency. Our goal is really focused more around things like ultimately looking to finance solar panels, solar farms, wind farms, really important green things that help the transition to a more sustainable economy, which means they're low carbon and ultimately they provide energy. I just put a heat pump into my house, is extraordinarily efficient. I get both AC and heat. And it's thinking about right now, most banks, their clients, they make their money exclusively off clients. Most of their clients are brown. Now, if you could start a bank from scratch or a finance platform from scratch and all of your clients were green, you've mitigated one area of risk, a huge area of risk. And the reason it's an area of risk is both regulations and legislation are moving the real economy in that direction. So the banks finance the real economy. The United States, Canada, Great Britain, Europe are tied to the Paris Agreement, which means, and by the way, the countries signing the agreement doesn't mean the countries decarbonize. It means their real economy actors decarbonize. So what most companies don't realize, from General Motors to your corner dry cleaner, that they need to have their carbon footprint reduced 50% by 2030, which is metaphorically tomorrow, and by 95% by 2050. So even though governments sign these binding treaties, what I think they failed to do, and they're just starting to do now through regulation and through legislation, is get the real economy to realize that they need to start changing their economy. Now, this is both an alpha opportunity of a lifetime, but it's also a huge area of risk. So consequently, if you don't start changing your business model in a few years, ultimately there's going to be costs on carbon. The Bank of England had projected roughly to $100 to $120 per ton, same with the OECD by 2030. Now, those could be either through direct carbon taxes, it could be through cap and trades on carbon credit programs. By the way, those are around the world now. And if you think about most asset managers and you run a cost of carbon in your COGS, your cost of goods sold within your P&L, and even if you start it at a small amount, maybe $25, $30 a ton, and run that out for the next 7 or 8 years, all of a sudden your EBITDA, your free cash flow, and ultimately your valuations are meaningfully different than what they are now in a high carbon economy. So consequently, our focus is on financing that transition in the real economy. So consequently, the banks have to do this for their brown ones, but we're looking to help drive it with the green ones, i.e. financing asset-backed securities of, let's say, if you're a Korean manufacturer of electric vehicles and you want to sell 250 million USD equivalent to Hertz for rentals in Manila, that's effectively a green bond, a $250 million dollar green bond.
I'm going to come back to my conversation with a cab driver, a very remarkably smart guy. I asked him if he likes hybrid cars. And we're talking about Toyotas. He said, no, I'm not going to buy a Toyota hybrid Corolla, for example, because it's several $1,000s to maybe up to $10,000 more than the regular model. And you basically have to run the car into the ground to realize the full amount in cost savings for fuel. And he said there's no difference in performance. In fact, the hybrid car is slower. There's this perception, Michael, that a lot of green technology right now is more expensive and doesn't really perform well as traditional technology. Is that something? And so this is a concern because people may not want to invest or buy things that are labeled green because of this perception. How would you respond to this?
No, that's a really good point. And with every new industry as it's moving. And by the way, look at Ford and General Motors. If I would have asked you 5 years ago, do you think Ford and General Motors would make a commitment to being 100% electric by 2030? You would have told me just not even possible. But to that point, there are costs associated with that. The amount of CapEx that those companies need to put in for new factories, is huge. And that does play its way through initially into the products. And as you know as well as I do, as you then are able to produce more of a particular type of product, costs come down, and ultimately, and by the way, the operating costs of an electric vehicle, the amount of moving parts. I'm the son of a General Motors engineer and then ultimately executive. And we grew up, and when I was growing up, those cars had economic obsolescence. Basically, they were meant to rust and fall apart within 3 or 4 years, and you replace them. Whereas the electric vehicles now, and think of the ones of the future, will last incredibly longer, less moving parts. So your operational costs will be lower. But to your point, initially, yes, the costs are higher. But let me shift for a moment to put my economics hat down. And you've spent a lot of time studying that. If you think about carbon and the other things that are related to climate as free riding negative externalities. It's a fancy word, but it means bad stuff that isn't included in the price of the product. So if you're making a car and you're not taking into account the negative externalities, that are associated with it. So the carbon goes into the air, that threatens the earth, but there's a lot of other things like NOx particles that also come out of emissions of diesel cars. In the UK, we had a little girl who passed away. She had respiratory issues and she lived near a large freeway, and the NOx particles ultimately killed her. But on a broader sense, the NHS tracks the cost of respiratory diseases tied directly to diesel cars and trucks. So ultimately, the pricing, even on what we call our standard things, are not correctly priced. There's free riding negative externalities. If you had to take responsibility for the plastic that goes into a product, that it comes back to you at the end, the cost affiliated that would be higher. So what's happening is so many products that we consume, we're getting them not at the true cost you would pay for if you eliminated those free riding negative externalities to them. Pollution's a free riding negative externality. When I worked for General Electric, GE Capital, in the 50s and 60s, GE dumped tons and tons of chemicals into the Hudson River. Ultimately, there were huge implications on that, public health, things that the cost of that. So if you were to eliminate those free riding negative externalities, ultimately there's been a lot of free lunches on a lot of products for a long time. And had climate not been an existential threat, they'd probably still be going on. But unfortunately, it's a wild card because it is a non-linear issue, whereas a traditional business works within what I would call linear economic models and things that you and I both understand.
It reminds me of the Ford Pinto case from I think the 70s.
Yes, I lived through that.
Yeah. I mean, we'll just end. We'll end in here. I know exactly how much it's going to cost me as a car manufacturer to either install batteries or build a battery manufacturing plant, so on and so forth. I know exactly how much it's going to cost for me to transition to an EV fleet. I cannot know exactly how much it costs for people dying of pollution, for example, from my petrol cars, or pollution done to the environment that may impact other businesses and indirectly mine. So if I were to take that position, I would say, well, one is a known cost, the other is an unknown. I would just not upgrade.
Yeah, though oddly enough, you can actually quantify. I'm a fellow at Cambridge University. Actually, you can quantify a lot of those unknowns. In the UK, the NHS could quantify very, very clearly not only the costs associated with the NOx particles, but also how many trucks and cars were diesel, who manufactured them, when they came in. So literally, you could literally say to Volkswagen, well, look, you sent us over this year this many diesel trucks and cars. This is the cost. This is how much NOx particles went into the air. You're X percentage of the UK fleet. So your check you need to write us to reimburse us for our health costs is this per year. And then you have the option. Either you can start going to your bankers and asking for loans to change your business model so you don't have to write us a check, or you can write us a check every year. So those are now becoming known costs. The effects of plastic is now becoming a better known cost. The pollution is becoming a better known cost. I would argue you're absolutely right. Probably 20, 30, 40 years ago, we didn't actually start quantifying the cost of those free riding negative externalities. But now we have that capability. And so it's trying to understand. I mean, I always use people, I might as well do it with you as well. This is my coffee mug here. To make this mug, somebody had to, do it in a manufacturing case. It probably used a fossil fuel. Then it probably went into a truck, packed in plastic. If you work it all the way through, what I paid for this cup versus probably what it should have cost me, and you can calculate that out. How much a sustainable cup should cost me, which again, this all has huge knock-on implications to the consumer society. And there's no lack of jobs that would be created on this, but it does make the cost of manufactured items higher.
Interesting. Well, Michael, very great talk with you. We covered a lot of ground. I appreciate your time for sharing your knowledge with us today. So thank you.
My pleasure. It's great to talk with you as well, David. Have a good day.
You too. And thank you for watching. We'll have more for you. Stay tuned and don't forget to subscribe.